The budget delivered finally the fine balance between being fiscally prudent and also increase a moderate capital expenditure. Now, this was the budget did deliver the big income tax bazooka to the taxpayers. This consumption boost will be most likely felt be in the. We are a tad disappointed on one point. Will they deliver a 25 basis point rate cut on the Feb's 7th monetary policy meeting? That could be, that could be a big cheer for the economy. So we would advise investors to use this heightened volatile phase to get into Indian markets at a much more reasonable valuations.
India recently announced its union budget for the year 2025-2026. What exactly was announced and what's the impact on India's equity markets? To discuss all of this, I have with me Nitin Jain, the CEO and Director with Kotak Mahindra Asset Management Singapore Private Limited. Hi Nitin, and yes, I first want to understand what your overall take was on Union Budget 2025.
Hi Mobina. Budget for fiscal year 2025-2026 was an expected line, with a very positive surprise for the Indian taxpayers. Going into the budget, there were moderate expectations. The key question was how to stimulate the economy and also be fiscally responsible. The government capital expenditure was running behind, budgeted lines, and the market was anchored to a more balanced approach between revenue expenditure, aka social spending, welfare schemes, or capital expenditure. There were some expectations in some quarters of a tax moderation for income taxpayers, and there were also some worries, on increasing capital gain taxes. So in totality, there was moderate expectation from the budget. The budget delivered finally the fine balance between being fiscally prudent and also increase a moderate capital expenditure. Now, this was the budget did deliver the big income tax bazooka to the taxpayers in form of tax rate cuts. So it is almost like $12 billion back into the pockets of the taxpayers. But there was a little bit of disappointment for the broader consumer because the overall subsidy to GDP went down from 1.3 to 1.2%. So the impetus will be limited to the middle class and the upper middle class. We are a tad disappointed on one point. Divestment, the government divestment has been running behind target, and there seems to be that strategic divestment is now of the agenda, and asset monetization is a moderate expectation going forward. We would have thought that, given that the government value of holdings has gone up so much, and in many companies there is very little free float, much less than 25%. Or there could be some supply of paper that can come from government holding. To put that in perspective, if you look at the value of the government holding, it is now more than $500 billion. That's around 13% of GDP. So there is that supply that the markets can also absorb that supply, and it is much required to increase the free float. So there was that disappointment in form of lower divestment target. On the capital expenditure, where there was the biggest debate, the current year numbers are obviously below last year budgeted numbers. When we look forward, the numbers penciled in are a 10% increase on the revised estimate for the current year. If you were to add the grants given to states, the number is more healthier at 17%, but that is prone to slippages. But there is a very clear pivot even in capital expenditure. Earlier, the focus was road and railways. Going forward, the focus seems to be more urban infra, ports and airports. But there is a clear moderation in capital expenditure going forward. Overall, a good budget, a good balanced budget with a big boost to consumption from middle class and upper middle class on the back of tax rate cuts. And there is no bad news, which is good news.
I want to expand on that point that you mentioned, that cash flow has come in the hands of the Indian citizens by way of tax cuts. In fact, the government did say that it will be foregoing 1 lakh crore rupees. That's running into billions of dollars via this tax cuts. This means straight into the hands of the consumer. Does that mean that the consumption sector could perhaps find flavor in India?
Yeah, as I said, this close to 1 lakh crore or around $12 billion of money going back into taxpayers' pocket. Obviously, there is going to be a boost to consumption. There is also going to be some, boost to savings on the back of this tax savings that the income tax filers will have. But as I said earlier, it is going to be limited to the middle class and upper middle class. The lower end of the society will not see any benefit because they are not tax filers. This consumption boost will be most likely felt be in the consumer discretionary line items, be it autos, be it quick service restaurants, hospitality, travel, be it e-com, quick com, organized retail, and even real estate. All of these sectors will look to benefit from the tax cut bonanza. But whether it will be a significant boost to consumer staples remains to be seen. As I said, there seems to be no incentive given to the lower end of the society. Looks like the government has taken a view that the federal government is going to focus on the income taxpayers, while the state government policies, which are now a little bit more oriented towards welfare scheme, will look after the lower end of the society. So a bit of a balanced approach going forward. So we see a decent consumption boost, but more in the consumer discretionary side.
The government continued on that path of fiscal prudence. 4.4% is what it has set its fiscal deficit target at for FY26. However, do you think this could come at the cost of growth in India?
So, Mobina, you can't have your cake and eat it too. We were asking for a fiscal consolidation pathway, which is much desired, and the government is delivering that. That means there is going to be some headwind to growth. But look at it, in the last couple of years, there was both a combination of fiscal tightness and monetary tightness. We see that monetary conditions are easing. Fiscal tightness after this year will also moderate going forward. So in our view, from here on, the twin headwinds are now looking to become more like a little bit of moderate fiscal tightness going forward. For Capex to increase from here on in a significant way, and at the same time being fiscally prudent, tax buoyancy has to increase. Now, we haven't seen any big tax buoyancy yet, barring personal income tax rise. But in future, we do expect with better compliance, tax buoyancy will broadly increase. That can support a higher level of capital expenditure at the same time being fiscally responsible.
Now, apart from consumption, do you think that there are other sectors that could find flavor in the market? For example, in this budget, the government gave a lot of focus to sectors like clean energy, electric vehicles, etc.
So apart from the consumption segment, this budget does give some benefit to clean energy. It also gives some benefit to or long-term view on nuclear power. There is obviously some incentives for the EV ecosystem, particularly batteries. So they take at the margin that is positive for them. There was reference to medical tourism and easing visas for patients coming into India. In our view, that's a very welcome step. India can become the hub for Africa, Asia healthcare, and maybe even attract patients from Europe and or maybe even US over a course of time. Obviously, there is a big thrust on increasing the footprint of airports in India. That should be a long-term benefit for the aviation sector in India with limited competition. That looks to be a good segment to be in. The budget largely was a status quo, and that is how it should be. We know that GST is outside the purview of the budget exercise. Maybe one could argue that the government could have given a hint of rationalization of GST slabs in this budget. But that being said, it could be very well outside the budget. So I think at this point of time, there is limited tailwinds for other sectors. Consumption is the big focus area in this budget. But one interesting outcome of a fiscally responsible budget, wherein we see that the net borrowing is likely to be flattish, is the impact on monetary policy. We have seen that the central bank has eased monetary conditions and is looking to be more growth oriented. Will they deliver a 25 basis point rate cut on the Feb's 7th monetary policy meeting? That could be a big cheer for the economy.
Do you think that after this budget, and especially the path that the government has set India on in terms of fiscal deficit, that India could finally see a rating upgrade?
So, Mobina, a rating upgrade is more of a medium-term outcome rather than a short-term outcome. As we speak, the combined fiscal deficit has indeed reduced quite materially from the peak of 13% that we saw in FY21 to expected level of less than 7.5% in FY26, which is year ending March 26. Going forward, we expect that the number is likely to be below 7% if one were to knock out the loans given from the center to the state, we would be below 7%, which is what the rating agencies are looking for. On a medium-term basis, the government in this budget, the government indicated that they will be looking at overall debt to GDP with a target of around 50% debt to GDP on the federal balance sheet by 2031. That also augurs well from a rating agency point of view. So I think if the rating agencies take a view of the fiscal deficit, combined fiscal deficit coming below 7% and long-term debt to GDP going towards 50% by 2031, we are in for a rating upgrade, but not in current calendar year, more likely an event for CY26. Please also do note that this current environment is a bit uncertain. We just had the announcements of tariffs from the US president on Mexico, China, and Canada. Emerging market currencies are in a bit of a tizzy. So I think rating outlook change is more likely a 2026 event than a 2025 event.
Nitin, to summarize this conversation, what's your view on the markets right now?
So, Mubina, after the recent volatility and the correction, bad news is par for the course. We highlighted that in our yearly outlook, that there are multiple headwinds that are now at the fag end of their impact. The peak impact of local headwinds, namely weak demand, extreme weather conditions, food inflation, weaker government spending, is all behind us. And we see some of these things changing for the better. After a very, very moderate year of earnings growth in year ending March 25, we see a healthy mid-teen to high-teen kind of earning growth for year ending March 26, with exit ROE of around 17% for companies X of energy, which is a very healthy outcome. We do expect that the investor turned saver, which is the domestic investor, continues to invest systematically in the market, and the global investor, which has been underweight, which is now underweight India, can have a relook at the Indian market. So we would advise investors to use this heightened volatile phase to get into Indian markets at a much more reasonable valuations.
Nitin, thank you so much for joining us. That was, of course, encapsulating everything that India announced in its Union Budget 2025. Thank you so much for watching. We'll be back with more such insightful videos on India.